Hey people, what's going on? Welcome back to the channel. Hope you're well and in good health. Stay tuned for this video. It's definitely an important one. We're going to be looking at interest rates and what's actually going to happen to them, particularly here in the United Kingdom. So right now we're on the Financial Times. Let's take a look here. So it says here, a milestone moment why economists think the global cycle rate of rises is over. So let's take a look at this. As evidence mounts, the global economic activity is slowing. Economists, financial markets, and most central banks have become convinced that no further interest rate rise will be needed. So obviously, we're looking particularly here at the UK in this instance. We were expecting rates to go to 5.5%, but they've actually not. They've currently sat at 5.25%. There hasn't been an increase. So this week, policymakers in the US, UK, Japan, and also Switzerland all decided to keep rates on hold. Central bankers stress the need to hold their nerve rather than tighten policy further as inflation continues to fall in most Western nations. Okay, we have reached a milestone in the global monetary policy cycle, said Jennifer McCune, chief global economist at Capital Economics. The global monetary tightening cycle has ended, according to her. For the first time since the end of 2020, more than the world's 30 largest central banks are expected to cut rates in the next quarter than raise them, the consultancy said. Financial markets have got the message. Traders now price no further rate rises from most major central banks and cuts by those in many emerging economies because a lot of businesses have been hit hard. Also, the real estate sector and other sectors too, because of interest rate and the rises in terms of paying back debt. Now, Nathan Shee, chief economist at US Bank, cited said that the global economy was approaching a transition point of lower growth and inflation. We're seeing evidence of a new regime characterized by gradual disinflation and decelerating growth, she said. Now, it says here the change in attitude follows reports of a slowdown in inflation in many countries and an OECD forecast showing that steep increase in interest rates over the past 2 years and a recent rise in oil prices to around $95 a barrel were generating increasingly visible signs of slowing growth. Now, here in the UK, we've seen that the economy is stagnating currently at the moment. Growth has slowed down a lot, so obviously there's issues around that. Now, central banks are beginning to respond to this data. Many emerging economies have started cutting rates while decision to hold rather than raise borrowing costs of Bank of England and Swiss National Bank surprised economists, right? We were expecting it to go to 5.5% here in the UK, but like I said, it's still on 5.25%, which has surprised some people. Maybe it's a method to help increase the economy or boost it, because we are also aware there is a potential recession coming up in the coming months as well, also going into 2024. Monetary policy makers in leading economies are not yet willing to talk about the possibility of rate cuts and are seeking to hold firm until there is more certainty that they have restored price stability. Now, the European Central Bank raised borrowing costs last week, but Philip Lane, its chief economist, said on Thursday that interest rates were on track to defeat inflation, providing they were maintained for sufficiently long duration at current levels. And it was basically the bank's strongest signal in the Eurozone itself, in terms of rates are likely to have peaked potentially. Again, we don't know for sure because changing economic factors could affect that. Now, the Bank of England here in the United Kingdom, members who have voted to hold rates, also stressed the need to keep monetary policy restrictive until material progress has been made against inflation, rather than just pushing for further tightening of policy. And then in contrast to that, in America, Fed Chair Jay Powell reaffirmed the central bank's belief that it needs to keep rates higher for longer to account for the fact that growth has held up surprisingly well in the world's largest economy. Richard Kalida, who previously served as the Fed's vice chair and now is at bond manager PIMCO, said the approach reflects the central bank's resolve to ensure against inflation proving persistent, right? He said the next move by the Fed, ECB and BOE would all be data dependent, and that would be jealousy guarding their reputation for price stability. Still, many economists question whether the Fed will need to be as aggressive on rates in terms of stabilizing prices in America, especially given the tightening of financial conditions that believe could offset the need for financial rise in terms of projected by officials in the updated economic forecast published this week. Now, Powell also made clear that the Fed's decision to hold rates steady should not be interpreted as a signal, the central bank though it had reached the endpoint of its tightening campaign. But the rosy outlook, especially on growth and employment, appeared fanciful to some. Monica Defend, head of the Amundi Institute, warned the Fed has done too much, and this amount of lag tightening will harm economy eventually. So in the United Kingdom, we can see that the wages have increased as well at the moment, but employment has also steadily been rising. Okay, people, I hope you enjoyed this video. Please do like, share, subscribe, comment below. Let us know what you think. Do you think there'll be a recession in the UK or broader in Eurozone, for example, or across the world? What do you think about interest rates? Will they go up or will they hold as they are? Let us know in the comment section below. Are you a property owner? Do you have a mortgage on your home? Do you have debt on a particular asset? Let us know how that's affecting you in terms of interest rates and so on. But please do like, share, subscribe to keep up to date with all the latest. Okay, people, catch you in the next one.